Now, sometimes getting a market-leading interest rate sometimes is just a little bit out of reach, and that could be one of a dozen reasons why, whether it's affordability, credit, income, you name it, the list can go on. But what I can do is help you understand your chances of improving that with a few key little tips. Hi, I'm Sam Fox, a mortgage expert here in the UK, and you guessed it, I talk about interest rates, mortgage applications, valuation surveys, anything to do with property. My goal is to help as many people get onto the property ladder and do it with confidence. So do me a favor, like and subscribe. It does our channel wonders, and we know that 95% of you who watch our videos don't actually subscribe. So don't miss out on our weekly uploads. Right, let's get to it. So let's start with your credit profile. Now, looking at your debts, and if you've got credit cards with high utilization, let's say 70, 80, 90%, do yourself a favor and pay off as much as you can on that balance. Having a high credit card utilization won't look too good in the eyes of the lender because it means you're trying to, you're maxing out against that top end of the balance, so pay them down. I'd always avoid taking on any new credit in the months leading up to the application. So if you fancy upgrading your car because you can afford to, and you're going to take out a 20 grand car loan, do yourself a favor. If the house is the priority, just keep the car that you've got for the next year or two. Make sure you get the house, and that'll help your chances on the mortgage application and getting that better interest rate. Now, make sure you're on the voters roll as well. I've seen this so many times. Be on the voters roll at home if you're still living there or your current property. Lenders will do a search, it'll flag up, great. It's a nice big tick for them. They can know who you are, they can see where you are, and it will go well for your application with them. So you tend to find the best interest rates are the ones that have got the lowest loan to value, or LTV. So the more you put into the property, the less risk to the lender, and they say, hey, you can have a lower interest rate. So the bands you typically find are sort of 100%, 95, 90, 85, 75, and then 60%. So if you've got a deposit of 5%, that extra 5% and buying with a 10% deposit could be massive, and it could mean, maybe £100 per month that you're going to save on the interest just by having a bigger deposit. So if you can do, try and save a little bit more. Now, also having a bigger deposit, going into other videos we've spoken about, means that you've got a bit more budget to spend on the property. So your moving costs, legal fees, solicitors, and it just eases that pressure for you. The next tip is to compare the total cost. Now, don't just look at the interest rate and say 3.99, have a bit of you. You need to make sure you're looking at everything. So does it have a product fee? Can you add it to the loan? Is there an arrangement fee that you need to pay up front, or an application fee of $199? Is there a valuation fee you need to pay on day one? Can you upgrade that to a building survey? Will it be cheaper to do it with a current lender? Are there any early repayment charges? Can you make any overpayments? What's the overpayment allowance? And most importantly, is there any cashback? As a first-time buyer, you should be looking if there's something to give you a free valuation or a free upgrade. And sometimes they do sweeten it with cashback as well. So if you've got a rate of, and I use the example of 3.99, but it's got a valuation fee, massive product fee, an application fee, there's no cashback, is it really going to be the best deal? It might cost you an extra 2-3 grand to have that, whereas the one that's got a rate of 4.15 might have all those things for free, chucked in. Happy days, it's going to work out cheaper overall. Next tip would be to use an independent mortgage advisor. Now, not only are we here to serve you and make sure you're maximizing affordability, getting the best product for your circumstances, but we're also in your corner. We can make sure that the application is an absolute breeze. We can preempt you as to what the banks or building societies will ask for, and we can be your friend along the way. Now, we'll often save you money and time, and we can also look at lenders that are more likely to accept your application from day one. So going back to that highlighted 3.99% rate, we might know you'll never be accepted for that rate. So save yourself the time, the heartache, the meetings, the paperwork, because we can tell you lenders that provisionally should accept you based on the information you provide us. So it's going to save you time and money. And last but not least is match the deal to your plans. So let's have a real good think about this. How long are you going to fix your mortgage for, assuming you take a fixed deal? Will it be 2 years, or is it going to be 5 years, or is it even going to be longer than that? Because some lenders will fix for a considerable amount of time now. Is your plans to renovate the house and move? Therefore, you might want to look at 2 years. Is it 5 years and you want that stability and you want to know exactly what your payments are going to be? We really need to consider these as well. We also need to look at flexibility. So can you overpay the mortgage? Is it monthly? Is it annually? What's the allowance that you can overpay? Can you take this mortgage with you onto a new house? So if you're 2 years into a 5-year deal and want to move, will the lender allow it? Or do you need to pay that chunky percentage early repayment charge, roll it into a new mortgage and move on? These are the sort of things that we need to think about. Life things as well. You're going to plan to have children. Do you need to move house in the future? And it all impact the deal that's going to match your plans. And the best rate isn't always just about what's the cheapest rate. It's about what's going to work for your lifestyle and your future plans. A really good consideration is the mortgage term. A mortgage term can be from 5 years up to 40. A 25-year term versus a 30-year term might save you £150 a month. Well, what's more important today? Is it that you've got the extra 150 quid to maintain your lifestyle as you get used to the house? And if you want to, you can overpay. Or are you keen on having a 25-year term regardless? So there are ways that we can make mortgages flexible for you to make sure, yes, you've found the house, but we're making sure your finances are manageable now and during the fixed deal or lifetime of that mortgage. And I'm going to take a deep breath there because I could waffle about this sort of stuff all day long. And Chris and Emma tell me all the time, Sam, shut up, you're boring us now, you're waffling, and nobody really cares anyway. And they're both nodding behind screen. I can see them. So if you do like what I've been going through today, please like and subscribe, as I said earlier in the video. And if you've got any questions about the home buying process, feel free to drop them in the comments below. It makes great content for us and keeps it fresh for what you want to know when it comes to buying a house. Any questions that you have, direct them to me, sam@ukmc.co.uk. That is me for today, and I will see you next time.